Good afternoon, our dear clients, and it is good to see all of you in our first session on the webinar, which we are going to cover most relevant topics. First one that we are going to cover, which is myself, I will be covering, is on the financial reporting, which is arising from the impact of COVID-19. So what we will try and do is that there have been so many pronouncements, some amendments, some modification which have been made to the standards. So what we will try to cover is a gist of the main summary areas, which will be having an implication for most of the participants who are attending this today's webinar. So what we have aimed is that we will not be going through each and every amendment in very detail. So even though there have been so many amendments which has happened, as I said, we'll be covering only those which are like in a gist manner, which will be more applicable from the practice perspective for your business. So I will take you through the agenda, what all things we are going to cover for today. To start with, this is a slide where we are having a summary of what all points I am going to cover in the first session. So as Samson said, today's agenda on the COVID-19 financial reporting will be covering only on the basic standards, which will be most relevant for your business. So first we will be talking about the COVID-19 relating to the rent concession. Most of you would be having a difficult time in terms of the COVID situation. And those of you who are having a lessee position where you have rented any of your premises from your landlord, definitely there could be an implication from the rent concession or a rent waiver, whatever be the terms that you use, which your landlord would have given. So that is one aspect that we will be try to start with that. We will move on to IAS 20, which is on the government assistance. As you all know, government in Bahrain, the Kingdom of Bahrain, the government has been very supportive in what all ways best they can do to support the businesses. So most of you would have received the government assistance either in the form of salary assistance for the employees, or even in terms of the utility bill concession and all those aspects. So how the accounting will need to be done, that we will be covering in the second aspect. And the third aspect is on the IFRS 9 financial instrument. As you all know, this is a very vast topic. To cover that in a very short time is not that practical. So what we have thought of doing is we are taking only the relevant aspects which has got impacted arising from COVID-19. So we will be covering certain aspects in terms of the trade receivables, which is on the expected credit loss model, that we will try to cover. We will also try to cover in terms of the financial liability, which how the accounting will need to be done. In terms of any of you will be having bank borrowing, there could be some restructuring or revision to the terms and conditions which would have happened. So we will try to cover that aspects, and we will cover some of the main highlights of the IFRS 9 in this particular section. After that, we will move on to the impairment. COVID-19 situation has been very challenging for most of the business across the region, across the geographical boundaries. So in Bahrain also has not been on any exception. So what we will try to do is that most of the businesses had an adverse impact arising from business, either business closure or they have to slow down. So most of these will have an impairment with indications which will need to be factored while you are doing a financial closing. So with that, after that we will try to go for the high-level disclosure matter, which will need to be covered when you are talking. We are talking not only for the interim financial statements. So all our clients which are having listed company status, for them, yes, we already have a disclosure which has been done in their Q1, which is March, as well as the June year end. So we are even talking about the year end financial statements, which most of you will be having, which will be on 31st of December 2020. So what all are the new disclosures which is need to be made in your financial statements, that we will try to cover in the disclosure section. And then going concern subsequent events, yes, this is also a hot topic which is arising directly from the financial impact or economic distress arising from the COVID-19 situation. So what all are the factors that you have to keep in mind while assessing the going concern, or even what could be a potential impact, because no one has seen till when this COVID is going to last. So it may sometimes if everything goes well, yes, there is a vaccine, but yes, there could be an impact that which may even go beyond the period of 31st of December 2020, which will be considered as a subsequent events. So there could be some extra disclosure either for going concern or the subsequent events. With that, we conclude, and then we will be taking the question and answer section, so which will be moderated by Samson. As Samson said, any of you have any questions, please type in your questions in the questions tab, which is on the right side of your panel. So we will try to take it towards the end of the sessions to make the session much more smoother. So without doing much about it, like discussing about the, let us talk about the topics which we are going to cover. As you all know, the COVID-19 timeline, which has been more or less like restricted to the year 2020. So we had a period which is starting from 31st of December 2019, which was the previous year end. So most of you may not be having any of the impact arising from COVID-19 unless until you have any operations based in China. Most of you will not be having any of those adjustments. But as you would have seen in your financial statements for 31st December 2019, there was a disclosure which was added towards the end, which was a non-adjusting type of an event. So this was restricted only to the disclosure. There was no financial impact. Comes January 2020, World Health Organization has announced this, that this is a maybe global pandemic, and then the financial impact has started becoming more and more widespread, spreading beyond the jurisdiction of China. It has been spreading to the other countries. And then comes March, yes, this has had even showing the financial impact or effect, which is across the board for all the region, including Bahrain. And then this is where the government across the jurisdiction have started making restriction, either in terms of closure of the business or in terms of travel restriction, which had affected the business in general, and due to which the financial effect has been much more significant. So you're talking about a timeline which is beyond 31st of March, any period you're talking about, you can understand that the effect of the outbreak has been very significant to most of the entities. So now let us look at the impact from the financial perspective. There has been certain amendments to the standards. So the first standard, as you all know, IFRS 16, which was relating to the leases. So this was a new standard, as you all would recall, which was effective from 1st of January 2019. So the 1st of December 2019, you would have concluded with the new disclosure relating to right of use of assets in your balance sheet with another corresponding impact on your balance sheet, which is the lease liability. On the P&L, you had an impact arising from the amortization of the right of use of assets, as well as the finance charges arising from the right of use of assets. So now arising from the COVID-19 situation, since many businesses were unable to sustain, so most of the landlords have given certain rent concession. So considering how to do the accounting for that has been clarified by the IASB, who had issued certain amendments, which is going to be mostly applicable for the accounting period or financial year and starting from 1st of January 2020. So you're talking about a period. So now let us look at the what all are the amendments which has happened. So as you all know, you have a position as a lessee or a lessor. So even though for the lessor perspective, there are no significant impact arising from the amendment which has been issued to IFRS 16. But from the perspective of a lessee, yes, there has been a practical expedient which has been issued by the standard setter, which is available for use in case you want to adopt it, which is making the adoption of the IFRS 16 as well as the accounting for the deferral of the rent as well as the rent forgiveness, whatever be the term that you use, to get included in your financial statements. So as need to be mentioned, this practical expedient is only an optional matter, so it is not a compulsory one. And this amendment was issued in the month of May 2020, and this has been having with an immediate effect. So any of the financial statements which are not getting finalized on 31st of May 2020, yes, this practical expedient is available for use. But of course, this will become for 2019 financial statement, this will become more of a subsequent events. But from 2020 financial statements, yes, it will be more of an on balance sheet or on financial statement impact. Now, if you want to understand what is this practical expedient, I will have to take you through a chart which will explain the entire concept very clearly. Now, the practical expedient has been made specifically to cater into the requirement of the COVID-19 situation. So there are certain conditions or criteria which will need to be met by the lessee in order to avail the practical expedient which is issued by the standard setter. So the first criteria is whatever be the rent concession that you would have got from the landlord should have been directly as a result of the pandemic. So if it has been, there has been some other discussion that you have been happening or holding with your landlord even prior to the pandemic situation, and the rent concession or rent agreement or terms and condition would have modified because of that, those discussion, yes, this practical expedient is not available for use. So this is purely, as I said, relating to COVID-19 pandemic rent concession. So if it is yes, then you go and check whether you are meeting the second criteria. Now, second criteria says that as a result of the negotiation or discussion that you are having with the landlord, the terms and condition or the lease payment which you ultimately make to the landlord should be either same or should be less. In any of the cases, if it is less or if it is same, then also the practical expedient is available. I will explain what is the practical expedient in the coming slide, but let's look at the criteria or the condition which you have to meet in order to utilize the practical expedient. So if it is yes for criteria 2, you move on to criteria 3. Okay. Now this criteria or this practical expedient is available for all the lease payments which is due on or before 30th of June 2021. So the standard setter has not concluded only with December 2020 position. It has gone further step for 6 months after the year end as well. So till that time, from the time it is starts till 30th of June 2021, this practical expedient is available for the lessee. So that is the third criteria. Fourth criteria, if there is a substantial change to the terms and condition, then this will not be considered as a practical expedient. In that case, you'll have to see it as a modification. So if all these conditions are considered, then once you are clear on that, then only you are available to use, or you are having an option to use the practical expedient. And in case if we are planning to use any practical expedient, you cannot pick and choose the leases. It has to be applied to all the leases which are having similar characteristics and in similar circumstances. So if you have, say, 5 leases, you cannot pick and choose, okay, for this lease I will apply the practical expedient, the second lease I will not apply. So that option is not available. Now let us look into what is that practical expedient that we are talking from the IFRS 16 amendment perspective. So this slide is talking about the summary in terms of what needs to be done in terms of application of the practical expedient. I will take you through the last column in terms of, like, in case you are eligible to use the practical expedient, what should happen on your financial statements. So we have on the left side, we have the effect on the impact on the lease liability, the discount rate, and the right of use of assets, and the impact on profit or loss. So let us look into each and every area. So in case a practical expedient is applied, what will need to be done is that the entire lease payment, what you do, what you make to what payment is made to the landlord is going to be calculated using the revised terms and condition. Okay, with the new condition, and based on that, you will derive the net present value. Now, in this case, for deriving the net present value, you're not going to change the discount rate. So the old exchange discount rate which have been used by you for the initial inception of the lease, when you have adopted the IFRS 16, the same discount rate can be used. That is one thing which is a relaxation for all our clients. And the second aspect is on the right of use of assets. So there will not be any significant change in the right of use of assets. So the impact will be only on the lease liability portion. So when you calculate the new present value based on the discount rate, there will be a different value. This you compare with the old lease liability, with your current lease liability. So whatever be the difference which is there, this is recognized. If it is a gain, it comes as a gain in your profit or loss, or vice versa. So this is the case where you don't have any complication in terms of calculation. And in case the practical expedient is available, yes, the entire lease payment is going to be considered as a variable lease accounting. So this is the case when the practical expedient is available. Now, in case you don't want to apply the practical expedient and you want to consider this, the significant changes has been made to the lease, not a result of the pandemic. In case you feel this is a modification to the lease accounting, so in that case, the calculation is a little bit complicated, but like I will try to explain how it will need to be done. So in case there is a lease modification and you don't want to apply the practical expedient, what you will have to do, lease liability, for that, yes, you have to again do the same calculation for the revised consideration. But in this case, you don't use the old discount rate. You will have to do the new discount rate, which is effective from the date of lease modification. So now what will happen, there will be a revision to the lease liability. So there will be a corresponding impact, offsetting adjustment also will have to be done to the carrying value of the right of use of assets. And the standard says is that any differences which is arising from the lease modification calculation, this will not be hitting your P&L, but this will need to be amortized or depreciated over the remaining term of the lease. So this is the main change, whether you are applying the practical expedient or not applying the practical expedient. So this is on IFRS 16. Now from the what all are the areas which are getting impacted from IFRS 16? So we will consider this from the two angles. One is what all are the areas which are getting affected due to the pandemic situation, and what all are the factors you as CFOs, CEOs, or business owners or accountants have to keep in mind. On the left side, we have mentioned what all are the areas which are going to get affected because of the corona situation. Yes, as we discussed, there could be a potential impact on the right of use of assets. For the landlords, yes, they are going to have a revenue loss arising from the rent concession which is being offered to their tenants, either be it a deferral payments or a rent-free period, whatever you call it. So there is going to be a revenue loss for those of you who are in a landlord position or lesser position. And there could also be a significant change which is in the either lease terms or which may require a remeasurement of your right of use of assets or the lease liability, which is already recognized in your 31st of December 2019 financial statements. So these all are the potential impact. On the right side, what you will need to do from your accounting perspective or from your financial closing perspective. As we said, you have to first of all determine whether the change to the lease conditions, either it is a modification or whether it is you are eligible to use the practical experience which is available, due to which you are going to treat the payments as a variable payment. So that is one. And of course, that will require a significant disclosure also, which will need to make. What are the assumptions that you have concluded, based on which you have concluded that this is practical experience is available and this is not a rent modification. So we'll cover the disclosure aspects in the subsequent slides. And this modification or practical experience which is going to be applied has to be retrospectively applied. But now one good thing is that generally whenever there's a retrospective application, the standard requires you to restate the previous figure. So now because of this particular one-off situation, IASB has said that any changes arising from the adoption of this amendment to the IFRS 16, you don't have to restate the prior period. So that is a good news for all of you. Okay, and as I said, this is applicable only to those rent concession which are arising as a direct consequence of COVID-19 situation. And from the lessor's perspective, over and above the revenue loss, yes, there could be also some indication of impairment of the rent receivables or lease receivable in their books, so which will need to be considered or accounted as per the requirements of IFRS 9. Of course, we will touch upon this highlights in the coming slides. So this is on IFRS 16. Now let us look into the second important area, which is on government assistance, which is covered by IAS 20. As you all know, most of the government, including the government of Bahrain, as I mentioned earlier, has been giving various financial packages or various incentives to the entities which are registered in the country. So various forms have been issued. Just to give a background, as you all know, the management should be considering the accounting for the government grants as per the requirements of IAS 20. So there is a classification in which case a amount which is received from the government is eligible to be recognized as a grant. There's a clear definition which is given in IAS 20 para 3, which says that anything which is having a value attached related to that assistance which is provided by the government, and where you can reasonably estimate the value which is provided to you by the government, that is eligible to be recognized or is available to be classified as a government grant. Now, whether you are eligible to be recognize the government grant and in which period depends upon several matters. So that now let us look into that situation. Now, what is the correct recognition? Okay. Now, first aspect, if you see, as I said, whether you are eligible to recognize this government grant, on what point in time you are eligible to recognize this also depends upon two aspects. One, there should be a higher probability that the grant will be received. And the second aspect, that entity that you as a company owner or a company, your company should be able to, in a reasonable position, to comply with all the terms and conditions which are attached to the government grants. So even for the salary assistance which have been provided by the government of Bahrain, there was a terms and conditions, if you all would recall, that like the employee should not be sacked within a timeline of so and so period. So if you see that you are able to comply with those terms and conditions, and you are probable that you will be receiving the government grant, yes, you are eligible to recognize the government grant. Now there is always a question whether how should I recognize, whether I recognize this in the P&L statement as an income, or whether I should recognize this as a deferred income and relating to the assets. So there are again two different accounting treatment which are available for that. So any grant which is related to the either income or expenses. So income is by way of, say for example, you are getting a Tamkeen subsidy, so it can be directly related to an income, or you are getting, say for example, salary subsidy relating to your staff cost. Government is giving you a portion of the salary as a reimbursement, say for 3 months, 6 months, depending upon the sector in which you are in. So the standard gives you two options. So in this case, generally, this amount is eligible to be available to be recognized in your P&L directly, since it is related to the revenue related activities. Now, the presentation is purely your choice. You as a business owner, you as a CFO can decide how you want to present the government grant in your financial statements. So there is an option which is available by which you can either show this as an other income. So you don't touch your expenses. Say, for example, you have a staff cost, you got an amount towards the staff cost as a reimbursement from the as a subsidy from the government. So you show the staff cost at the full amount, but the amount that you have received from the government, you show it as a part of other income. So that is one choice which is available. The second choice which is available is to reduce your staff cost and show the on a net basis. So both the options are available. The standard says both ways the presentation is correct, appropriate. There is nothing wrong in that. So now this is related to the items of subsidy or government grant, which is related to revenue items. Now looking at the grants which are related to the assets, again, there are two ways of accounting which is available. One, either you reduce the carrying value. Assume that you have purchased a machinery against which you have received a government grant, either from Tamkeen or from some other agencies, so which is eligible to be recognized as a government grant. So in this case also, there are two accounting options which are available. Either you show the grant net or reduce the value of the grant from the carrying value of the assets that you have acquired, and you show the asset at the net value, or you show the asset at the gross value. If you want to know how much is the actual cost of the asset, you recognize the entire asset at the gross value, and the amount of grant that you have received will have to be recognized as a deferred income, and that is getting amortized or back and recycled into the P&L over the estimated useful life of that particular machinery against for which you have received the government grant. So this is in terms of the government grant. Now let us look into the third area, which is a little bit complicated, IFRS 9. As I said, IFRS 9 is a very vast area. So today, for the presentation perspective, we'll try to cover the important areas which we feel like are more relevant, applicable to the attendees to the seminar or to the webinar. So we are not going to cover certain areas like hedging or like no other complicated area, since it may not be that much relevant to your business. Now, looking at the IFRS 9 also, the common scenario that we can see, which all of you might have like seen in your business also, there are different line items, financial instruments which may get affected arising from COVID-19 situation. The first one is relating to the impairment of the financial assets, which are either carried at amortized cost or financial assets which are recognized as other comprehensive income. So any financial assets which are having a fair value which is routed through other comprehensive income, there could be an impairment indication, or be it an indication of the instruments which are carried at their amortized cost. Second area, as I said earlier, there could be a significant modification to your fees finance liability. Most of the bankers in Bahrain, as you all will be knowing, those who are having a financing facility with the bankers in Bahrain, they have been like based on the guidelines issued by the Central Bank of Bahrain. Most of the banks have been offering deferral, either in terms of deferral of the terms, repayment terms, or there has been some concession which have been issued in terms of the interest rate. So there could be some implication from the recognition of or the measurement of the financial liability. So we will try to cover that area also. On the financial assets, in case you are having any receivables, you in a principal capacity, you have issued any payment holidays to any of the borrowers, yes, you have a financial assets. So the similar implication also will be there relating to the corresponding impact on the financial liability, so that you will have to recognize as a loan issuer in your financial statement. There could be potential impact from COVID-19. And then my main thing, what you all would agree, is on the volatility of the fair value. As you all know, market has not been steady. We have seen many stock market, especially like overseas, which has shown a big plunge because of the, especially for the equity instruments. So, and even for the debt instruments also, the fair value, there has been a significant diminution in the fair value. So there could be, these all are directly related to COVID-19. And lastly, but not least, is talking about the financial guarantee. Assume that you have a group company. This is more applicable to the any other related party borrowing position, where you as a principal or a parent company, you would have issued a financial guarantee to your another group company just to enhance or provide them the availability of the credit facility for them. then there could be some potential impact in case that related party is going into situation of maybe a loss situation. There could be a potential impact on your financial statement arising from the financial guarantee which you have issued. So we'll try to cover some of these aspects in our financial statements. So as I said, in terms of the fair value measurement is the first topic. As I said, like there has been a high volatility in terms of the market, and in some cases also you would agree the market has been more or less stagnant, and you will sometimes you will even feel that the market is no more active. So you will be feeling that, okay, is that right to take the market value which is available, which is as per even on an inactive market? So that is one thing, is a direct impact of COVID-19. And then talking about the fair value hierarchy, there have been different levels like level 1, 2, and 3. So there could be a shift from level 2 to 3 or level 1 to 2. So which could happen arising from the COVID-19 situation. So any shift from level 2 to 3 also, or any shift between the levels also will require an enhanced disclosure. Now, from the financial perspective, from the reporting perspective, what you have to do is that in case you have any of the assets which are having in the nature of a financial instrument nature which is covered by IFRS 9, you'll have to keep in mind the fair value should be keeping into consideration the market condition. So don't think that, okay, yes, fine, I am fine with it, I am not able to, I don't have a liquidity situation. So you may have to even consider a distress sale. So what could be a potential fair value in case you are not able to hold the investment at a current value or maybe current situation, and you may need a immediate cash assistance or liquidity. For in that case, you may have to sell these assets as a distress sale. So when you, as you all know, whenever you do a distress sales, you don't get a fair value which is actually reflected in the market. So you may have to take a big hit at that point in time. So even while closing your books for 31st of December 2020, this distress sale situation have to be kept in mind. Okay, now again on the market value, as I said, you could see a market which is not at all active. So that doesn't mean that the market price has become unobservable. So still you should be, the standard is encouraging you to take the market which is available, even though it has not been that active. So the prices which are quoted in the stock market prices, we still, the reference will be still the open market which is available from the stock market price. And these all are the instruments which are in the level 1, which is a direct relation to the active market, or which is listed in the stock markets. So this is on the implication. Now let us look at the scenario of the 3-stage level model. As you all, whenever you do a like maybe credit risk assessment from the initial recognition, most of you, as you would recall, you will be doing an expected credit loss model from for your receivables or for your any other assets where you have a credit risk. You don't consider beyond a 12 months period. So which is generally in the stage 1 criteria. But because of the COVID-19 situation, some of your credit risk exposure would have expanded beyond the 12-month criteria, which is even going to stage 2 or stage 3. When this situation happens, what will happen is that the standard requires you to determine the lifetime expected credit loss. What it will mean that you don't look only at 12 months down the line, you have to look at the entire time till the time you recover the full value, what could be a potential loss which you could face. So that entire loss will have to be considered in your credit risk model while doing an assessment at the year end, while like for your all your instruments which are having a credit risk. So this is a significant change. So any of your clients, any of your financial instrument which is having a credit risk, this will be very much applicable. So there could be some surprises that you will be facing because of the stage shifted from stage 1 to stage 2 or 3, basically. Yeah. Now looking at the scenario of the trade receivable, as I said, now most of you would have used the simplified model. So the previous model is on the calculation which is based on the other than a simplified model. So most of you which are having a simple model of credit loss, you would have followed the expected credit loss, which is based on a provision matrix, okay, which is similar to the table that you can see in the current slide. So what you would have done is that you would have done derived at the expected default rate, and you would have applied that your carrying value in various aging bucket, either 1 to 30 days or 31 to 60 days, 61 to 90 days, and so on. And based on that, you would have derived the expected credit loss, which is generally the provision that you create. So for the non-lender, the simplified ECL can still continue to be used, but you have to keep in mind the expected default rate. So which will not be only the historical condition, you'll have to look into, sometimes there may be a requirement even to look into the future conditions also. Now looking at the modification in terms of the deferral payments. As you all know, like the lenders or from where you have borrowed the money, there has been certain modification to the terms and condition, such as like bank loans. The bankers would have given you some modification, either by way of a grace period or a reduced interest rate. So these some of these modification either may sometimes qualify to be treated as a modification. So there's a different accounting treatment if the entire arrangement, rearrangement, or a revision to the agreement is treated from the modification perspective, or if it is not a modification. I will try to explain that in a simple manner. What the standard says is that in case you have a financial liability, just let us take a simple example of a loan. So which is a financial liability. You have taken a term loan from the bankers. Okay, now the standard has told you you have to determine whether the changes in the terms and condition, whether they are substantial or non-substantial, because the accounting treatment in both the cases are going to be totally different. Now, how do you as a finance manager, how do you determine that your financial liability has become a substantial modification or not? So what the standard says is that you have your present value of the cash flows, which is based on the original terms and conditions, that you have to discount based on the effective interest rate. Okay, so based on that, you compare that with the revised cash flows, which you would have estimated based on the new cash flows, expected cash flows, revised cash flows with the original interest rate. So you have an original calculation, to put it simply, in terms of the cash flows discounted using the original rate. The same rate you apply on the revised cash flows also, which is based on the new terms and condition. And you compare these two values. If the impact is more than 10%, then the standard says, yes, there is a substantial modification. If it is less than 10%, the standard says that, yes, there is no substantial modification. So the accounting treatment, what is the change between the two situations? Let us look into that. So if there is a substantial modification where there is a more than 10% difference, what will happen is that the standard says that you have to de-recognize your current finance liability. The current loan that you have taken has to be de-recognized, and any cost which are associated, which is relating to the rearrangement or a deferment or what you have been paying to the bankers, will have to be recognized as a gain or loss on extinguishment of your financial liability, the previous liability. And then you recognize the new liability based on the new effective interest rate and based on the new terms and condition. So this is the situation which happens when the financial liability has gone through a substantial modification. But in case that percentage of gap is less than 10%, the standard says this is not substantial. You can continue to recognize your financial liability, which is at the current value. Of course, you have to revise the carrying value for the new cash flows based on the original effective interest rate. So you will be doing that adjustment to the present value based on the new expected repayment terms, and any fees and costs which you are making, which are paying to the bankers, will have to be deferred over the remaining term of the liability. So this will be absorbed to your P&L over the remaining life of the thing. So there is a significant difference is in terms of how you recognize the cost related to the assets, sorry, the revision to the liability, and whether you will de-recognize the liability or not. So it all depends upon whether the modification is substantial or non-substantial. Now, having said that, this slide I have already mentioned, explained in terms of what is substantial, what is not substantial. So I'm not going to take you through again that. Now let us look at the another important area, which is on impairment of the assets, which is driven by IAS 36. As I said, there are different areas which are going to get impacted. The standard has been always there, but because of the COVID-19 situation, there could be certain triggers of impairment, which you as finance manager or like business owners have to keep in mind while doing your financial closing for the current year. Now, if you take on an example, goodwill, assets like goodwill, or whichever has an indefinite useful life. Okay, now those intangible assets, which are what the standard says is that, as with the current standard, these have to be tested for impairment on an year, every year, but also whenever there is an indicator for impairment, you have to do that impairment assessment as per IAS 36. So this is the current standard. Now in terms of other non-financial assets like property, plant and equipment, right of use of assets, or any intangible assets which are having a definite useful life. So what will happen, as per the current standard, the impairment testing is needed only when there is an indicator of the impairment, is existing. So this is the background, just to give you an understanding of what is the current requirement in terms of impairment testing. Now, looking at the scenario, what could have happened to the business or the carrying value in terms of the impairment, what will need to be considered for your financial closing. As you all know, there are two sectors or two sources of impairment. Either it can be an external source or it can be an internal source. Now, looking at in both these conditions, these have to be factored while doing an impairment assessment. So from the external sources point of view, on the left side, as you can see, there are certain cases where the asset value carrying value would have significantly declined because of the indications from the market, so that you can get some indication from there, or the market or the economic environment or legal environment itself would have gone through a drastic change, which is resulting maybe some outlet you would have closed down, say for example. So that may result in an impairment of the assets which are related to those businesses which have been closed down, or where you have substantially discarded their operations. So, and the third case of scenario, wherever the net assets which is for the entity is more than which is the market capitalization, this also is giving an indication of an impairment. So these are the external. So some of the, I'm not capturing all the 8 topics, but I'm talking about the key factors which can give you an indication for the external perspective. Now, from the internal sources, yes, you all know, you may have decided, okay, well, you have maybe 10 lines of business. Maybe you would have thought, okay, maybe a line of business or a line of production you may stop because the market is not that active. So you may have to curtail the production. So you may see, okay, some assets, let us keep it at idle. We will continue to use it whenever there is a market is opening up. Or you may even think of discontinuing that line of business, because it may not be anymore economically feasible for you to continue the business. So in those cases, yes, this is an internal source of indication of impairment. And also, if the economic performance of an asset has been or if you anticipate that it is going to be worse from the internal reporting perspective, that the amount of economic cash inflow that you are going to expect to generate from the use of the asset is going to be much more worse because of the COVID-19 situation, that is also another indication of an impairment. Now, what will need to be done? How do you assess the impairment? So everyone says, yes, do a calculation for impairment, but no one really tells you how to do an impairment assessment, isn't it? What the standards, I will give you a background on that through this current presentation, current slide. So what you do is that you have a current carrying value of the asset of a cash generating unit or a group of cash generating units. That carrying value, you compare that with the recoverable amount. So now, what is the recoverable amount? Either it can be fair value less cost over disposal of that particular asset, or value in use. So whichever is higher is generally considered as a recoverable amount. So if the recoverable amount is lesser than the carrying value, means assume that you have 100,000 as the carrying value of the assets, but the recoverable amount either through use or by this calculation is only 90,000, that is giving an indication of impairment loss to the tune of 10,000 dinar. So that is an impairment loss which will need to be recognized in your profit or loss as per the requirement of IAS 36. Now, looking at the cash flow model, again, yes, it's not going to be that easy for you to determine what could be the value in use. For that, what you have to do is that you have to do a forecast of expected cash flow from the use of the assets for the impairment calculation. So, of course, there can be different scenarios. No one knows when this pandemic is going to end. So you can have a worst case scenario, you can have a positive case scenario, or any case in between also. So you as a management or you as a finance person, what you have to do is that you should not stick to only to one scenario. You have to see multiple scenarios, and each and every scenario you have to give probable weight based on your anticipation, how your business is going to recover, or how you feel that what could be the prolonged time for which the impact is going to happen. So this will need to be based on that, all these criteria, probable weights, which is assigned to each and every scenario, you come up with a potential or most probable cash flow scenario. And this is the cash flow forecast which will need to be considered by you for your impairment assessment. So as I said, this is the amount probable with the probable weight. This is the value which you use for value in use calculation for your impairment assessment. Now, again, talking about the indicators of the impairment, which all are the areas which can get affected? If you ask me, I will say line items like goodwill, intangible assets, PPE, property, plant and equipment, means your fixed assets in your investment property, which is carried at historical cost, because fair value, obviously, you will take the market value. You have line items called right of use of assets that may get affected also. And investment which are in either associates or joint ventures, which are equity accounted, also may get impacted. And then any value in use calculation have to be adjusted. You cannot use the previous concession or previous assumptions which have been used. And there can be there could be a significant decrease in the fair value and active market also may not appear. So these all are directly related to the impact of the corona situation. And what you have to keep in mind from the financial reporting perspective is the calculation of the cash flows, which is where, for which, as I said, you have to consider all available information. You have to keep in mind, as I said, you have to think about from a scenario of a multiple scenario, don't stick to the one scenario only. And all this calculation should be based on the best estimate which is available for you as finance team at the reporting date. And importance is again coming to the disclosure. So all the changes in the assumption, the factors that you have considered for your impairment have to be disclosed in your financial statements. So in terms of the subsequent events from the impairment perspective, so as I said, you can have to consider all the available information, be it budgets, forecast, which is available at the period end. Impairment test may not be updated for information which is subjected to the subsequent to the period end. Assume that you are closing at the December, some in the month of say May or June, when you come to know about some revision which is to the estimates, you cannot go back in time and then like change the December calculation. Means hindsight is not allowed as per the standard. Okay, so this is from the impairment of the assets perspective. Now the key items that you have to keep in mind also, all the impairment analysis indicator of the impairment, whenever there's a there, you have to do that calculation. And as you all will be knowing, any goodwill impairment, once goodwill, in case any of you will be having goodwill in your balance sheet, if there is any impairment which is done for goodwill, it can never be reversed. Okay, so that can need to be kept in mind. And if there are any high levels of uncertainty which is there on the market situation, you are unable to determine, you have to do your best effort with the available information which is available. Yeah, and then subsequent information, as I said, yes, that can give you some indication, but it may not be the sole information which should be used for your doing your estimation. That is from the impairment perspective. Looking at the disclosure perspective, what all things need to be disclosed in your financial statement. As I said, previous year it was a more of a subsequent events. For the current year, it is more of a like maybe a year where you have all felt the impact of COVID-19 situation. So as you all know, the entire set of financial statements are prepared based on certain assumptions, certain estimates, certain judgments, which is all made by the management based on the best case information which is available at the time when the financial statements are prepared. So because of the COVID-19 situation, there could be several areas which could have gone for a change, or some revision would have been done to the estimates, some judgment would have to be done. So all this will have to be disclosed in your financial statements. So as you all will be knowing, you may see in the current year, there could be, depending upon the presentation style that you want to see, on the right side, you can see new line items in your financial statements, either by way of rent concession that you are got from the landlord, or by way of government grants, in case you have to write down your inventory because of the current COVID-19 situation, or any other impairment losses that you would have seen. So you can expect to see new line items in your financial statements, which is directly arising from the COVID-19 situation. Even as you all, those of you who have been regulated by Central Bank of Bahrain, there has been a specific requirement, or even for the listed company, that Bahrain boards has said that there should be a separate line of disclosure or separate section in the financial statements, which requires the impact of COVID-19 situation. So this was mandated by the other authorities other than the Ministry of Commerce. So, but at the end of the day, whether it is mandated by the ministry or not, the IFRS standard says that there should be a separate disclosure for the impact arising from the COVID-19 situation. So this will need to be made for all your financial statements for the 31st of December 2020. Now, talking about the disclosure relating to the going concern, what you will need to consider is that, yes, some of you would have been very badly affected because of the COVID-19 situation, or maybe you may have to be, maybe you are just getting a pinch of the COVID-19 situation, which make like by way of like incurring losses, market is not available, your demands are not picking up. So some of these may also give you an indication of the going concern. So what the entity needs to consider is what are the significant uncertainty which is affecting your future events, and you will have to again not stick to one model. You have to look at the probable reason or multiple scenario which is getting involved, and what are the probable weights, which is based on the best estimate of the management, which will need to be considered. Now, entity, as I said, they have to disclose all the key judgments, estimates, while arriving at this conclusion, including the sources of information, the assumptions used, and what all are the aspects which are being considered from the various financial assistance, be it from government or from the lender. All those things will have to be disclosed in the financial statement from the judgment perspective, or based on which you have made the judgments or estimates. COVID-19, there have been some illustration which is made available to us from the Video Global office. We'll be sharing that also with our clients. So which is talking directly in terms of like what could be a potential impact. On the right side of the screen, I know it is a little bit smaller screen, but you can expect to see new disclosure which is being made in the financial statements, especially for the areas relating to estimates and judgments. So from the disclosure perspective, as I said, each and every transaction you have to see from your business perspective. So it's not that you have a group of company, all of them will be having a similar disclosure. No. So you have to take entity by entity and what all are the significant effects and transaction, and you will have to cover this as a separate note in your financial statements. So in terms of the any assumption, as I said, so I will not repeat it again. So this will need to be done from the management perspective, and this can be validated by way of a disclosure. So video publications are available. So most of our clients are already having that available. So some of you don't have that publication. We will be circulating this again. What could be the practical aspects in terms of the disclosure which will need to be made on the financial statement? What should be the practical scenario which you should be considering? In each and every scenario, there are different publications available. We will make that available to you. In case any of you don't have that, please feel free to contact us. We'll be more than happy to assist you on those. So I think with that, I am summarizing my session. So my contact number as well as Sam's contact number details are available. Of course, you have your service line managers also. You can contact any one of us. Now, I think that we'll be more than happy. So let us see that like the COVID-19 situation will come to an end sooner, if not later. So which will, and then let us hope that the business will turn into a like a positive and coming back to the usual position as from the past. Thank you so much.
Thank you, Samson. And thank you, Nath, for taking us through the details of how financial statements have to be prepared in light of COVID-19. My apologies to bring COVID-19 into tax, but that is the new normal as we call it. So I'll spend a minute on that. Whatever will be an adjustment in the financials from a COVID-19 side has to be relooked at from VAT separately. As this session predominantly deals with a situation where NBR is going to revisit the VAT returns, maybe possibly do a reconciliation with the financials. And if you have any adjustments in the financials, they need to be relooked at from VAT perspective separately. And what I saw in the webinar is that if you are going to land up in a situation where you have long-term contracts continuing, qualifying as a continuous supply, and if your billing milestone has come and you have not really billed for it, this also needs to be looked at from a VAT law perspective separately. A second point related to COVID and to tax I wanted to touch upon was the due dates. As you would know that there were no relaxations from the NBR side on the due dates. That was predominantly to deal with the fact that VAT is going to be collected and paid to the government. But as we know that VAT liability gets triggered most likely on billing, which means that you prepay the VAT liability without even making a collection. So it will be worthwhile to watch, how the government is going to deal with this, and whether there is going to be any relaxations on the due dates to make the VAT payment and to file the return. Before we dig into the session for today, I wanted to share with our clients the changes in the broader GCC region, and I will only spend a minute on that. As we all know that the VAT rate in Saudi Arabia has been bumped up from 5% to 15%. So this will cast a substantial burden on the Bahraini-based, VAT registrants from a VAT perspective. If there is a situation that you are getting any supplies out of KSA and they were liable to 5% VAT, depending upon the VAT rules in KSA, this will have a significant change for you, because now the 5% is going to be a 15%. And ideally, in a global parlance, usually a VAT of one country should not be levied to a recipient in the different country. That is the general logic. But if in your case, you are going to be liable to VAT under the reverse charge, as well as getting charged VAT from a supplier in a KSA, this needs to be relooked at. So please do reach out to us if you have a situation like this. Similarly, if you have any services being received out of UAE, you must have recently seen that the export of service, a definition in the UAE VAT law has been made more restrictive, which means that if you or your company through your people have a physical presence of more than a month in UAE, and the services which are provided by the UAE service provider are linked to your supply, this means that the UAE supplier will charge you a 5% VAT, which leads you to the similar kind of a situation that I was speaking from a KSA side, that you could land up in a situation where 5% UAE VAT is getting charged for you, you being the recipient in Bahrain. So such kind of a situation can be avoided if you relook at the the laws of both the countries, and this will be a substantial relief if you are landing up to pay a VAT of both the jurisdictions. With this, I will move into the current, crux of the webinar, is mainly to do with how NBR is going to look at your VAT returns which are filed. So the VAT journey till today in Bahrain is being short. The VAT went live for most of you on 1st of January 2019, and as last as 1st of January 2020. So all the VAT registrants have filed a VAT return. As you would know that the VAT return is more of a summary form. It will just give you the consolidated numbers which are getting reported to the government. So the government is really keen to find out that what are these various consolidated numbers, the standard rated, the zero rated that we are submitting from our end. So as most of you would have seen that on a filing of the VAT return, there will be an email or some scrutiny started from the NBR side. So today's session is going to mainly focus on that. And I hand it over to my colleague Tushar, who will take you through the details. And we will come back online to take any questions from you. Over to Tushar. Thank you.
Good afternoon to all attendees, and thank you, Ashish, for handing this over to me. We can move to the first slide. So the topics that I'm going to cover today are NBR assessments, and I'll be touching upon a few recent updates that NBR has come up with in the recent times. So first and foremost, one question that could arise in our minds is that why are we saying that NBR is conducting assessments, audits, or examinations? Why are we using three separate terms for something which has a same meaning actually? So the answer to that is pretty simple. NBR officials themselves interchangeably use these terms. They sometimes would issue you a letter saying that we would commence your review of Q1 2020 for that matter, or we would like to examine your details filed as in the VAT return for a certain period, or we would like to assess your VAT return. So these terms are interchangeably used by NBR. Even in the general VAT guide, which is issued by the NBR. By NBR, as we all know, I refer to the National Bureau for Revenue, which is the tax administering authority in Bahrain. So even in the general VAT guide, which is issued by the NBR, these terms have been used to refer to tax audits which are to be conducted by NBR from time to time. So they would refer to a review or an examination, assessment, or audit interchangeably. So so having got that into perspective, it would be pertinent to understand as to what are the objectives of NBR behind conducting an audit. So what comes to my mind, the three most important objectives or the aims that NBR would want to achieve. The first and foremost objective is that, as we all know, today we are in the 22nd month of introduction of VAT. VAT was introduced in Bahrain on 1st of January 2019. So today we are in the 22nd month of introduction of VAT. So NBR today, as of today, as we speak, NBR has a huge data bank of tax returns. A lot of information has been lodged, filed into the NBR portal. So NBR is in a position today to cross-check the applicability of tax or the taxability which is assigned to a specific transaction by an industry player vis-a-vis the taxability assigned by a competitor to the similar transaction. So NBR can do that comparison. NBR can look out for any deviations in the taxability assigned by two separate taxpayers, and wherever they find any variances, they can initiate the audit very easily. So now today they are into that driver's seat, as if I may put it that way. So that is the first objective. The second objective is that when we file our VAT returns, we file it at, as Ashish said, we file it at a totality level. It's a very simple form, as we all know. I mean, we have to provide the total of the standard rated sales, the total of the zero rated, and total of exempt sales, and so on and so forth for a total of purchases as well. So when NBR conducts audits, it will want to go to the granular level details of these totals as to what have we filed when we have submitted our returns, as to what we have provided as data for purchases and data for sales. So these granular level details are what NBR would want to try to assess basically. And the third important objective that comes to my mind is basically, many taxpayers even today have this misconception that when we talk of sales, we have to only report the main product line or the main source of income which a company earns actually. However, that is not the case. That is a misconception. What NBR is wanting to be or what wants to be reported, what NBR wants information in the return pertains to basically all supplies which qualify, all transactions which qualify as supplies as per the VAT law. So, so the information pertaining to all the supplies as per VAT law has to come. So that may not necessarily mean that you have to only report your main line of income. It also has to include transactions such as deemed supplies. It has to include transactions such as intercompany income, any miscellaneous income, other income, as you may account certain items like, or maybe related party transactions, or also have to be reported as a part of your sales income. So many clients, even as of today, miss this miscellaneous items, and that is exactly where NBR latches upon at the time of audits. So having said all of this, it's important that we maintain a reconciliation between the financials and the VAT return data which has been filed, so that we can upfront come across any errors or any misouts that have happened at our end when we have filed the return. In fact, it is a practice, it's a matter of hygiene, if I may put it that way, that we have to maintain reconciliation between financials and the VAT return numbers immediately after we file the VAT returns, especially because NBR has the VAT law empowers NBR to look back at returns for a period of 5 years. So for a 2020 return, which has been for a Q1 2020 return, NBR can come to you and ask for the reconciliation statements even in 2025, because as I said, NBR has a 5-year look back period basically. Yeah, we can move to the next slide, please. Yeah, So in this slide, what we have tried to do is we have tried to put together certain questions which our clients have, been asked on a regular basis by NBR. So we have made a quick compilation of the regular questions that NBR has been asking to our clients. These questions might seem very innocuous or maybe very innocent looking questions, basic questions, but actually, as the saying goes, the devil lies in the details. So you need to be extremely careful while submitting each and every number to NBR as a part of your reply to the NBR. So and in fact, if you have submitted any data at the time of registration, you have to be more careful, because NBR also goes to check, or rather cross check, the data which is submitted by you at the time of registration. So if it finds any variation in the data, which is, they'll do a comparison basically between what you have estimated at the time of registration vis-a-vis what you are filing as a part of the return. So if there is any deviation, they can very well ask you the reasons for that, and you have to provide them as a part of the reply. Over here, it will be pertinent to also mention that NBR has been asking minute details, such as the movements in the trade receivables, the movement in the bank balances, the opening and closing bank balances. What are the major items reflecting in the bank account of a company? What is the type of that receipt? Is it an advance? Does it constitute a taxable supply? Basically, all these questions are something which NBR has been regularly asking, and actually it has taken us by surprise, because NBR has suddenly, it seems, pulled up their socks and they have smartened up. And in fact, yeah, that could have been expected at any point in time. So due credit has to be given to NBR, because they have given us quite a long time to get our systems up and our reconciliations done. So I mean, yeah, the questions have now definitely smartened up. And all said and done, it is time that we also have our books prepared through maybe regular health checks, or maybe revisiting our returns immediately after a period of, say, a month after we file them, and so on and so forth. Yeah, we can probably move to the next slide. Yeah, over on this slide, what I have basically put together are the various stages through which an assessment goes, the assessment cycle per se, if I may put it that way. So like I was mentioning on the previous slide, NBR would start with initial querying. There will be query letters that will be issued to the registered ID of the authorized signatory. It's also important to note that at times the authorized signatory might be traveling, or maybe out of office. So the chances of such email being missed out are also high at times. We have seen that practically happening. So NBR issues emails notifications on the registered ID of the authorized signatory, and also on the NBR login, there is a questionnaire that is posted, which needs to be answered within a time frame of typically 7 to 8 days. So after you, and there can be multiple query letters that could be coming in, and you have to answer them within the stipulated time frame. We have had cases where there have been continuous querying for 2 to 3 months. Around 20 to 25 letters have been answered by our clients. Only after that, when NBR gets hang of your data, it would be in a position to move to stage 2, where they are in a position to declare a preliminary assessment letter to you, or issue a preliminary assessment letter to you, saying that we have done this preliminary analysis of your data, and the VAT liability that you have mentioned in your returns is this much, and as per our calculation is this much. So there is a differential liability that you need to pay. So if you're okay, and if you're ready to accept the differential, so very well and very good, you can just pay it off and go back home and have a good nap. However, if you are not in acceptance or in agreement with the assessment, the preliminary assessment which NBR has done, you can go for a reassessment. And unfortunately, if the reassessment again results in a negative order, the recourse that you have is to file an objection. The important point to note in case of an objection that has to be filed with the TARC, which is the Tax Appeals Reviews Committee, which is the third stage basically, which I'm referring to. The important point over here is while filing the objections, you have to pay the entire tax amount along with the fine which NBR might have imposed for a late payment or late filing. So the third stage basically comprises of filing of objections with the TARC, or God forbid, you might have to also move the courts in Bahrain if your objections do not go in your favor. I mean, the result of the objections filed do not go in your favor. So the only option which remains with you is to move the courts in Bahrain basically. So basically, these are the three stages through which an assessment proceeding moves. We can move to the next slide. Yeah, so wherever NBR finds that there is a difference between the liability that you have paid, or it comes across some other types of errors, depending upon the time frame within which the error is identified or the nature of the error, the offense basically, there can either be an administrative fine or a penal, a criminal penalty which can be imposed on you. The administrative fine typically would be in cases where you have underpaid VAT within a period of 0 to 6, and you have paid that within a period of 0 to 60 days. The quantum of the penalty would be a small one, 5 to 25% of the underpaid tax basically. And why am I referring it as a small one is because can we please move to the next slide? Why I'm saying that it's a small penalty, because as we can see in case of criminal penalties, the penalty which you'll have to pay, the fine which you'll have to pay is 100 to 300% actually. So yeah, so it's a huge variation. I mean, 5 to 25% of the underpaid tax vis-a-vis 100 to 300% of the tax that is underpaid. And one point to be noted over here is that the imprisonment which I have mentioned in this slide is not an option to a non-payment of 100 to 300% penalty. It goes along with the penalty amount, because the term used in Article 64 of the VAT law is "and". So imprisonment and 1 to 3 times the unpaid tax is the phrase which has been used in Article 64. So God forbid, again, you need not have to be categorized as a tax evader, or even need not have to pay any fine. But the point which I importantly want to drive home is that you need to revisit your returns thoroughly after you file them. Maintain reconciliation of your books and the numbers that you have filed in your returns. At the same time, it's important, and I can't emphasize on the importance more of conducting health checks, taking opinions wherever necessary from a consultant or through the NBR. NBR has tax ruling procedures as well. So your consultant can guide you to get tax rulings in, so that whatever positions are unclear, you can get them clarified before NBR starts their audits basically. So these are certain hygiene and maintenance kind of points which we have to inculcate in our VAT processes on a day-to-day basis basically. Yeah, can we please move ahead? Yeah, so basically that was what I had to mention on the assessment processes. I would now touch upon a few recent NBR updates. Actually, I have mentioned them in a reverse chronological order. I mean, the new ones are coming first, and the ones which have been issued maybe 6 months in the past are listed down. So basically, there are two very important or relevant guides. One is the Economic Activity Guide and the Transfer of Going Concern Guide, which was issued by the NBR. Economic Activity Guide is pertinent because it really emphasizes on what has to be categorized as an economic activity vis-a-vis something which is something which is an activity done on of irregular nature basically, which is not frequently done, but it involves some monies basically. So there is a clear-cut differentiation given between an economic and non-economic activity. Similarly, in case of transfer of going concern, what are the VAT implications of a going concern, the input tax recoveries, and the conditions for, in case of a going concern being a part of a VAT group, what are the implications are specified in this new guide. Then there are a few clarifications which were issued by NBR in line with the CBB circular for interest payment holiday. So this is important in case of taxpayers who are in financial services sector, because this has a direct implication on their reporting of exempt income basically. And then there is a small procedural procedural facility given in respect of the zero rating of services availed for building permits basically, or obtaining building permits. And there is a very beautiful guide for retail and wholesale sector, because there are quite a few areas and very minor points which the NBR has touched upon in respect of retail and wholesale sector. In fact, one can have a separate webinar on the guide which the retail and wholesale sector has been issued by NBR basically. Yeah, we can move to the next slide, please. Yeah. So on this slide, I have basically made a mention of the various facilities and services which NBR has, extended. NBR has, made big strides as far as, extending facilities to, the taxpayers are concerned. Most of the processes now, I can say, are made online. One can sit at one can continue working from home or any other part of the world and continue filing their review requests. Their assessments can be done on an online basis. Any deregistration request can be filed online. Most of the processes are online. It's paperless, almost seamlessly done. Yeah, and as far as VAT payments in Bahrain are concerned, NBR, I think it's almost 4 to 5 months now that what VAT payments can be done through your debit cards. You just need to get that system facility updated for yourself. Earlier, it was only through a direct bank payment or through use of a VAT facility. So now you can use your cards as well to make NBR VAT payments. Yeah, refund application for non-residents. This is currently being operationalized, is what we understand. In the month of then for COVID-19 affected businesses, there were certain concessions given on a case-to-case basis. This was not for all taxpayers at large. Only if a taxpayer is facing dire dire consequences of the COVID-19 situation, NBR has extended certain facilities to them in respect of timeline, extended timelines and all. And last but not the least, NBR has been making efforts to have its portal, all the details of the taxpayer in line with what the MOIC portal has. So basically, NBR has been sending continuous reminders to all taxpayers to update their details in line with what the details of such a taxpayer would be available on the MOIC portal. So basically, these are the updates that I wanted to cover. And in case of any questions in respect of any of the aspects that we have covered, we would like to welcome those questions. Thank you.
Thank you, Tushar. Before we take over the questions, two things I wanted to stress upon. As you can see that the VAT law has been evolving not only in Bahrain but in a balance of the GCC countries also, which means that the positions which you had adopted as on the 1st of January 2019 or the applicable date of registration have been evolving too, which means that there could be a need to revisit the positions specifically from a systems and a processes side. And the second thing is that, as you would have seen in the last 20 minutes or so, that NBR has become really, I would say, active in terms of going behind taxpayers who are not complying with the law or not making the VAT payments on time. So given this, where we can help you with two things, rather than waiting for a notice from an NBR to submit the details, and which in my personal view is a very simple email without citing any article or anything that you will get from NBR on the registered mail ID. So not waiting for that, it will be very crucial for you to do a mock assessment at your end. And working in the VAT or the sales tax or the GST sector for such a long time, reconciliation with the financials is a very crucial thing, which you should plan for beforehand. So if you want to do a mock assessment, we can do a health check, which mainly covers a review of the positions and as well as reviewing the compliances. We have got an opportunity to revise the returns as well. So if we come to a conclusion that maybe something is not reported in the a VAT return, or something needs a revisit from a reporting side or the payment of liability, we can support you to revise the returns as well. And of course, the last thing, if you get a query from NBR, don't treat it lightly. Respond on time. As you must have seen on the previous slides, that even if you don't respond to the queries or just say silent on that, there could be penalties there. So please do reach out to us if you need our support preempting the notice, or if the notice comes from NBR. So with this, I hand it over to Samson to take the webinar forward.
Guests, like we have the last session for today. I know we are running late by another 10-15 minutes. We will try and wrap it up by maybe 5:10. So this is the final session for today, where we are going to cover the topic relating to the recent amendments to the Bahrain Commercial Companies Law. As you all know, almost a week or like two, there has been a decree, a media decree, which has been issued relating to the Commercial Companies Law amendments. Certain provisions of the Commercial Company Laws has been amended. From the practice perspective, there are so many questions which are still not clear. Even though the amendments have been issued, the legislative decree, which actually talks about the specification or the procedural guidelines which will need to be followed by each and every company to comply with the regulations or the new amendments, has not yet been issued. So our legal team is constantly in touch with the respective authority. So based on the feedback which has been received from them, this is expected to take the procedural aspects or guidelines most probably will be available in a month's time or something. So for today's session, it was supposed to be taken by my colleague in the legal department, Mr. Mohammad Abdul Salam, but since he is unable, he's not available in town and he has been traveling. Due to that, like now, I've been tasked to handle this assignment as well in terms of the Commercial Companies Law. So without doing much into the background, so with that background, we'll try to see what all are the major amendments which has happened to the Commercial Companies Law. The first amendment has been relating to the single person company status. As you all know, we have a legal person status, which is SPC. So now that provision has been done away with. So there are no more SPC companies going forward. So what it means that all the companies which are currently owned by a single owner or a single, be it an individual or a separate legal entity, all those will have to change their legal status to either WLL or to some other status, whichever they feel. But now one good thing is that the limited liabilities company, which was actually previously more than one owner, minimum 2 owners are required for the WLL company. So that can now be owned by a single owner. So in case any of you have like WLL companies, you want to change from a 2 owner to a single owner, that can also be done. Now, in terms of the time frame, there is a time frame of 6 months by which like the conversion needs to happen from the SPC company to a WLL company. So that has been the significant change in terms of the SPC status. Now, second point, amendment has been relating to the minimum share capital requirement for the WLL company. As you all will be having a background from the past, that 20,000 Bahraini dinar was the initial share capital requirement of the WLL company. But of late, there has been some concession, almost a year or two now, wherein like the Ministry of Commerce has reduced the share capital requirement even to Bahraini dinar 100 for the WLL companies. Now, with this amendment, there is no minimum share capital requirement. But now the thing is that the procedural aspect relating to the reduction from 20,000 to 100 was not regularized in the Commercial Companies Law. So with this decree or with this amendment, this also has been regularized. So as I said, Ministry has not yet announced the limitation or which all sectors this minimum share capital or nil share capital will be applicable, or minimum share capital will be applicable. Even though there may be different categories. So it depends upon which sector you are belonging to. So which sector will be eligible to be having a minimum share capital requirement as per this amendment can be known only once we have the acceptance guidelines. Now, third important aspects, of course, this is relating to the issue of preference shares. Of course, this is not available for all the companies like WLL. So this is available only for Bahraini shareholding companies. So with this amendment, the over and above currently, as you all will be having the equity shares, with this amendment, even preference shares can be issued. Now, one thing you have to keep in mind is that even though there is a provision in the commercial companies law to issue the preference shares, the articles of association of the company will need to be amended suitably, so that it should also give an authority to the company and its board of directors or the shareholders to issue the preference shares. And of course, while doing this amendment, as you all will be having a background from other jurisdiction, preference shares always have a preference in terms of their rights and then privileges in terms of either in terms of voting or in terms of their participation in the profits or like any other rights. So all those things will have to be in detail considered and then explained in the memorandum articles of association, which will need to be amended. Once it is amended, yes, the Bahraini shareholders company can issue the preference shares. Look, moving forward, there has been some amendment relating to share capital increases. Of course, I will not call it as a typical amendment. This was always put into practice. There are different means, as you all know, by which the share capital of a company can be increased. And this particular amendment is applicable for all the companies. So I'm going to talk about only the 3 areas which are new, which was not there in the previous commercial companies law. So one is by way of a conversion of a loan bond into shares. So this is applicable only again for the joint stock companies. So wherever if you have a loan bond which has been issued, and then instead of repaying the loan back to the creditor, if you want to convert that into by way of issuing the equity shares, that is not now possible. This is only for joint stock companies, as I said. Now, in case there are any other dues which are for other companies or for all the other companies, in case you have a normal creditor to whom you have to pay, but now because of the current situation, or you want to take that creditor as a shareholder in your company and issue them the shares, now that is possible. So no need for a creditor to bring in new funds. So the current loan balance which is payable to the creditor can be used to capitalize in your by way of issuing the shares and then increasing the share capital. Now there is also a possibility of issuing in-kind shares. By in-kind shares, what I mean is that in case your shareholder wants to introduce certain assets by way of their fair value needs to be contributed by way of a share capital contribution. So instead of following a cash contribution, this can also be as another way where the share capital can be increased. Some of these aspects which have been already followed also in the past, but with this amendment to the commercial companies law, this particular these 3 ways of increasing the share capital has been regularized. Now there is an amendment relating to the statutory reserve. As you all know, like statutory reserve, or we call it as a legal reserve, is generally created by way of a transfer of 10% in the years where you have profits. You transfer 10% of your net profit to a separately designated reserve, which is called statutory reserve or a legal reserve. Now there are certain restrictions in terms of to what purpose this can be used. Now again, with the current situation, the statutory reserve is available only when the company is going into liquidation. So that particular provision has been amended in the commercial companies law, which now says that in case the company has an erosion of capital which is arising from these accumulated losses, and if you want to avoid or regularize their share capital erosion and then do away with the accumulated losses, for that purpose the statutory reserve can be used. Okay, so this is one purpose for which the statutory reserve can be used. And the statutory reserve can also be used in case a company is making a regular profit distribution, and in case in a particular year you don't have sufficient profits, and then you still want to declare that minimum profit or by way of dividend to your shareholders. In that case also statutory reserve can be used, provided the statutory reserve is exceeding that 50% threshold. Because there are certain companies who don't stop their transfer to statutory reserve only to 50%, which is the minimum requirement as per the commercial companies law. So some companies even go up to 100% of the capital. So wherever you have an extra statutory reserve which is available, which is exceeding that 50%, that surplus amount is now available for dividend distribution. Previous to this amendment, there was a specific approval which was needed from the Ministry of Commerce, that the company have to write in person to the Ministry of Commerce and get a prior approval before utilizing the statutory reserve. But now with this amendment, that special permission is not needed, because it has become as a part of the commercial companies law itself. So that was on the statutory reserve. As you all know, in terms of the next amendment is relating to the board of directors, which is the report of the board of directors to the shareholders of the company. All the financial statement as per the commercial companies law need to contain a director's report. And this particular amendment is only relating to the shareholding companies. So what it says that any shareholding company where there is a director's report, of course it is required, they need to have contain a comprehensive statement of all the remuneration which has been paid to the board of directors. So that is the first amendment. So you will be making certain payments by way of salaries, which is, if it is for a executive director, you will be paying them a sitting fees, you will be paying a board participation fees, or you'll be giving some other fees, by whatever nature you call them. All those remuneration which has been paid to the board members, board of directors of your company will need to be, there will be a comprehensive statement included in your director's report talking about that, how much amount has been paid and when, how it has been paid. So in which form it has been paid. So that is first amendment. And over and above the payment made to the board of directors, the amendment to the commercial companies law also states that there should be a separate disclosure relating to the remuneration paid to the executive management. So all the executive management, you are paying a salary, you are giving a remuneration which is related to the profits of the company, or you are paying maybe some other incentives. So all those incentives or remuneration in whatever form which you are paying, that also now will need to be disclosed in the face of the director's report also. Currently, as you all will be knowing, this disclosure is currently now covered in our related party transactions for the year. Now with this amendment, this will also need to be captured in the board of directors report. As you all know, the shareholding companies need to contain special reporting from the auditors talking about how much is the related party, details of the related party transactions and balances, which was in fact started from the previous year. So with this amendment, over and above that reporting, you will need to continue to have a report or disclosure made in the director's report itself. Now, talking about the other amendments, now as you all know, there is a special rights which have been given to the authority of the chairman of the board. Now, there has been certain practical situation where the chairman is not available. So what happens is that in case a chairman is not available, maybe some companies are getting stuck because they are not able to process certain documents, because without the signature of the chairman, generally the Ministry of Commerce will not accept any changes, which is generally need to be regularized. So in that case, to meet that requirement, the BCCL amendment says that the company's articles of association can be amended to make in a manner that any other directors can be given such, can be delegated such authority of the chairman in case the chairman is not available. So you don't have to wait for the chairman in case the chairman is not available because he is traveling, he or she is traveling, or they are not available due to certain situation. You can continue provided your articles of association is containing this amendment relating to delegation being given to another director. Moving on to the publication of the notice of the AGM. This is a small amendment. This is again applicable only to the shareholding companies. Previously, as you all know, the publication will need to be done in at least in one local newspaper, which is in Arabic. So now with this amendment, which says that both English and Arabic newspaper should be local. In case the company has any overseas shareholder, in case they want to publish anything overseas also, that is an optional thing. So instead of making it mandatory for one local newspaper, which should be in Arabic, another local English newspaper also has been added. Another amendment is relating to the strategic shareholders. With the current Bahrain Commercial Companies Law, there was no provision relating to the issue of shares for the strategic shareholders. Many businesses, as you all know, like there could be definitely some strategic tie-up with certain stakeholders who cannot become a shareholder because these people are generally the one who are providing some technical support, or they are key in terms of their operational aspects or marketing support to the company. Now, with this amendment, shares can now be issued to the strategic shareholders. Further amendment is relating to the board membership. As you all know, any changes to the board of directors, I'm talking more from the shareholding companies, wherever a new board member or is going to be appointed, or any current board member are going to be reappointed, certain information regarding the candidature of those shareholders who are proposing themselves for the board member needs to be provided. So now ministry, there was bigger ambiguity in terms of what will need to be disclosed to the shareholders. So with this amendment, the commercial company law contains the list of information which will need to be provided about the candidate who is going to be proposed for the post of the board membership. And this information also will need to be given along with the invitation to the shareholders meeting in the annual general meeting. Now, last couple of other amendments relating to the employee stock plan. So some of the companies, especially if you're looking from the overseas perspective, even some companies in Bahrain also, they do that. They issue shares to their employees by an employee stock option. So now it was not regularized in the commercial companies law. So with this amendment, now companies can issue shares to their own employees just to incentivize their employees in case anyone want to go into that route. Now, all the details of the full details of the terms and condition, on what date it is available, or what all are the conditions which will need to be met by the employee to be eligible for employee shares plan, will need to be disclosed to the employees of the company. So that was an amendment, new article relating to the employee share plan. Now, another significant amendment is relating to the not-for-profit organizations. Now, as you all will know, currently the not-for-profit organizations are not under the purview of the Ministry of Commerce. They are more driven by the Ministry of Social Affairs. So there has been a new amendment which has been made for the commercial companies law, by which any not-for-profit company can be now registered as a WLL company. So most of the companies, they will be having charities, so which was previously driven by, or any other NGOs which are currently now driven by the Ministry of Social Affairs, can now be under the Ministry of Commerce if you are registering themselves as a WLL company. Last but not the least, there was a voting relating to the electronic voting, thanks to COVID situation, wherein most of the AGM this year had happened through an electronic means. So Ministry of Commerce has supplemented that efforts of the companies by allowing the electronic voting, wherein like if the provision is available in the articles of association of the company, you can have such voting which can be done through electronic means. So these are the major change. As I said, most of the information relating to the legislative amendments or procedural aspects are not available. We will try and get that information. Hopefully, we are following up. Our legal team is following up. We have mentioned here the contact details of Mr. Mohammed Abdul Salam, who is a senior legal consultant for the BDO's legal team, who can be contacted, or in case you want to contact any one of us also, we are available. So as and when we are having more information, we will be planning for such further webinars, which will be used to most of you.